Smarties, and welcome to Thrive in 25 Unlock Passive Investing, our webinar series from Westcliff, where we talk about opportunities for you to increase your returns in real estate investing. Today, we're happy to join and have a guest. His name is Ribhu, with some extensive experience on the financing side of things. Today's agenda, we'll talk through a bit of an introduction on Westcliff, learn more about Ribhu, and of course, dive into financing, specifically CMHC financing, and the advantages they can have for real estate investors like you. As far as Westcliff, we have myself, Jaffer. I'm a CPA, CA, and a registered dealing representative with Waverley Corporate Finance, over 20 years experience in the industry. I'm joined by my partner and co-host, Addy Saeed, who's a licensed realtor, has been involved in real estate acquisitions for over 20 years as well. He is also a registered dealing representative with Waverley Corporate Finance. At Westcliff, our mission is simple. It's learn, invest, and manage. On the learn side, we offer opportunities for investors and people who are interested in investing in real estate to learn more about the markets and different ways that they could invest. In the invest side of things, you can learn more about how different opportunities that are available, or we may co-invest in opportunities, or clients that we work with that could be a potentially good fit from a real estate investment perspective. And then finally, from a managed standpoint, we offer full real estate asset management services, everything from property management, accounting, all the way through to your day-to-day maintenance and management of capital projects, as well as development feasibility. If you want to learn more, please reach out and book on our calendars at cal.westcliffam.com or visit our website, www.westcliffam.com. With that, let's dive right in and get to know Ribhu a little bit. We're pleased to have you here. Thanks for joining us today, Ribhu. Why don't you start by introducing yourself so our listeners can learn more about you?
Thanks, guys. And first of all, thanks, guys, and Addy for having me here. Pumped to be here. A bit about me, currently focusing on commercial mortgages and all things multifamily. It's a space that really fascinated me. I got into the game about 10 years ago as an investor myself. Born and raised in Trinidad, came up to university, into corporate, used to work for Procter & Gamble. I saw real estate investing as the path to kind of break it to that whole next level and essentially hit certain goals that I had for myself. So started off back in 2015 with duplexes, triplexes, flipped a couple of houses, that type of thing. Quickly learned though, it wasn't very scalable, as well as there wasn't a lot of margin in that business. Frankly, it wasn't an up market, which we were in at the time, but I knew it wouldn't last forever. So my business partners and I, we pivoted into multifamily real estate. I tried my hand in different businesses, property management, construction along the way. But what I really loved was finance. Got my mortgage license, I left corporate. And since then, I've just been focusing on building my own portfolio, but primarily helping investors scale their own. So we focus on the 1 to 10 mil loan space quite a bit, helping investors who have duplex, triplexes, trying to figure out how to get into multifamily investments, or clients who have a couple multifamily and want to scale into bigger and bigger things. So yeah, that's what I've been up to. It's been an interesting market. A lot of investors seem to be back out to play right now after taking a couple year hiatus. Yeah, seeing a lot of movement in the multifamily space right now.
It's amazing because that's how you and I got introduced as well. Because we have a client that is looking to move from single family duplexes, triplexes, and he's looking to get into multifamily. And you and I got introduced because I sent an email out in my database, and you were part of the database saying, "Hey, we're looking for somebody, a mortgage broker that can help with this specific type of clientele." Because, as you know, when you're working in real estate and you're working with a lot of different professionals, you want to find professionals that are experts in their particular fields, so they know the ins and outs of what's happening in that marketplace. So let's step into CMHC. Anytime I hear somebody like, it's word on the street is that if the taxi driver or your cabbie is talking about something, it's already been overdone. And CMHC, every cab driver that I know or agent that I know right now is basically sending us emails saying, "Hey, you got to be looking at MLI Select mortgages." So why don't you give us a rundown? What is CMHC and why CMHC mortgages for multifamily matter and why investors should be paying attention to CMHC?
Sure. Yeah, and you're definitely right. It's hit the mainstream. It's something that's been around for some time, but more and more people are picking up how advantageous it can be, especially in today's market. So at a high level, CMHC is a mortgage insurer. We'll focus, I guess, on this podcast on the CMHC-insured multifamily loans. They have their own apartment construction fund. I think you guys talked about it on previous podcasts for the sake of the CMHC-insured multifamily loans. What makes it so attractive is a few key things. One, it's lower interest rate, generally speaking, which everybody loves. Two, amortizations can get pretty extended, 45, 50 years in some cases. And three, the debt coverage requirements needed to qualify for it tends to be lower than a conventional financing. So simply put, for the same asset, you can qualify for a lot larger loan. And CMHC, depending on the number of points and the type of product you're using, you can get up to 95% financing, which is another big driver of people getting into this. I think traditionally, a lot of Ontario assets in particular, in order to debt service on a conventional multifamily loan, you'd probably be looking at 25, 30, 35% down. So I think this is starting to make some of these smaller multifamilies a lot more accessible to more people, which really, really picked up popularities, especially in the Alberta market, where people are seeing opportunities that qualify pretty easily for 95% loan to value. And that's really spread like wildfire. You don't have land transfer tax. There's a lot of other benefits of investing in those markets. But yeah, you're seeing a lot of people get into that and try to scale up their portfolio. So it's an interesting time. And then I guess my last point is we're in this interesting window of opportunity, I feel, where prices have come down, rates have also come down, and the market hasn't really rebounded yet. So you're seeing more opportunities where, like the deal we're working on together, Addy, where it actually qualifies on the acquisition for CMHC financing, which is wild. Like this, for somebody to be able to get something of that size, CMHC acquisition, without having to do any crazy value add is phenomenal.
No, it's amazing the opportunities we're seeing in the marketplace right now. Let's talk a little bit about the eligibility and criteria. So you touched a little bit on debt coverage ratio, you touched a little bit on amortization. All of these obviously work together to come up with a formula. Can you just give an idea to our listeners what kind of size, occupancy that is required, asset type, any thresholds that investors should be aware of?
Sure. Yeah. So we'll focus on the multifamily financing. CMHC also funds student housing, etc., focusing on apartments. The minimum requirement is you need at least 5 residential units in the property. You can technically get away with mixed-use properties, but the commercial component needs to be less than 30% of the total square footage, and you still need that minimum 5 residential units
Now,
in
should
order
we
to
add a
qualify.
caveat that it has to be legal 5 units? It can't be legal
Yes.
non-conforming. It has to be legal because people get caught with this all the time. And I'm sorry to interrupt, but we see marketing brochures coming from for like rooming houses where the agent is even touting you can get an MLI mortgage for this property. No, you can't because it's not a legal unit. So sorry to interrupt, but yeah, legal 5 unit plus, right?
Yeah, that's great that you brought that up. That could definitely kill a deal, and you want to know that up front for sure. It's a great point. So yes, legal 5 units and above, we're good to go. From a debt servicing standpoint, for people who may not know, the CR ratio is essentially the net income of the building. So your rent minus expenses as per the CMHC benchmarks divided by your mortgage payment. So depending on the type of product, I'd say CMHC, for the sake of simplicity, has 2 main buckets. One, CMHC standard multifamily financing, and then MLI Select, which is what everybody's talking about. Generally speaking, I mean, there's situations where CMHC standard has higher debt coverage requirements, which makes it a little bit harder to qualify, and MLI Select is 1.1 across the board. Now, with that comes some caveats because there's points, 3 buckets of points that you need to score points on: energy efficiency, affordability, and accessibility. Their website's pretty thorough in how that's broken down. But on a high level, it's pretty tough to get affordability and accessibility points on the smaller assets in Ontario, anecdotally speaking. And where you see most people leaning towards is going the energy 50 points route, which is fairly straightforward process on qualifying for. But yeah, once a building qualifies, you meet the debt coverage requirements, you meet the criteria, then they look at the borrower covenants. But a high level, again, is very borrower specific. That's what I love about commercial financing. Everything's a bit of a business case by itself. It's not as black and white as residential. But generally speaking, they're looking to see that you as a borrower have decent credit and are going to debt service your car payment, but they want to make sure you have financial strength behind you. Minimum 25% net worth of the loan you're requesting. So if it's a $2 million loan, you need to have at least $500K net worth. That can be in real estate. They do look for roughly 10% liquidity out of that mix. Once you meet those criteria, you're in the gateway. I mean, that's very high level. There's a lot more nuance and steps to it than that, but that's at a very high level summary. Barrier to entry.
Basically, you pointed out a couple of great things: lower interest, lower debt coverage, higher amortization. All of those equal higher prices, if I'm not mistaken, because what we're seeing in the marketplace right now is a lot of salespeople and a lot of the sellers are backing in a value using the MLI program. So how do you keep your investors safe from something like this, where you do have a salesperson that is backing into a value using the MLI numbers and saying, hey, you know what? You can get 95% loan to value, purchase this property with 5% down, and generate a 20% return.
Yeah, so that's a great point. We're definitely seeing inflated asset values across the board. I'd say, especially in Alberta. What I'd say is CMHC at the end of the day is just a financing tool in the tool belt. As people have told me, and I agree with, if the deal isn't a good deal, if you didn't have CMHC financing, it's probably a bad deal. I agree with that. So, I mean, like, there's functions if you want to put less capital in and you want to leverage a tool. I love the tool, even for myself, I use it. But yeah, if some of these overinflated deals, if the rest of the fundamentals don't make sense, if this program wasn't a thing, it's probably not. That's my opinion. That's usually part of what we do up front, right? Is underwrite, show different financing options. Here's what it would look like for conventional. Here's what it would look like for CMHC. Here's what the increased APR is of the insurance premium added on versus conventional. And figuring out what that return on capital is. But yeah, bottom line is if it's not a good deal without it, it's probably not a good deal.
Just wondering, Ribhu, when you were mentioning you're comparing the conventional to the CMHC, when you're comparing them head to head, just for our listeners' benefit, what do you see typically, whether it's a percentage difference or money in their pocket? Like, how would an investor perceive the difference between those two programs and how it could improve their returns?
Sure, I wouldn't say there's necessarily a general trend. Well, I guess a number that I can put it, but generally speaking, the return on investment, because the invested capital is lower in the CMHC scenario, tends to be a higher return because of that. However, the returns on the conventional side, it's not that it's bad. It's just that it requires a lot more capital, and your return on capital is going to be lower because the capital outflow is a lot higher. But yeah, I'd say if you meet your minimum investment criteria on the conventional lens, CMHC just is cherry on top.
Makes sense. And then you mentioned the affordability criteria is hard to qualify for. So are people generally going the energy efficiency route and the point system? Like, how are you helping your clients navigate through that?
Yeah, so where I say it's hard, so like technically it's easy, but so like affordable rent is defined as a percentage of median renter income based on the geography you're funding in. So let's say Toronto is 13 and change, 1350, I believe it is, for the affordable rent metric. It's tough to commit to affordability, qualify for your debt coverage ratio like Toronto asset prices. And also, it's a tough sell to have a 10-year affordability commitment when you only have like 8 units in a building, because we're talking about investments of that scale, right? So most times we get 50 points purely from energy efficiency, which is a percentage improvement over baseline. There's 3 tiers. I can't remember the exact percentages offhand. Usually that's where the energy consultant helps out. Generally speaking, to get into MLI in Ontario, especially Southern Ontario, we're hitting 50 points of energy efficiency improvements.
So then if I'm an investor looking to take advantage of the MLI program before I even buy a property, do you get in some of these consultants in early as part of due diligence? Like, how do you, because you don't want to walk into an investment and not qualify for MLI. Your deal could fall apart, right?
Yeah, 100%. We'll be engaging them from day one. There's that ecosystem of people that we work with, whether it be consultants or appraisers, everybody in the ecosystem who we've done deals and we trust. They brought in pretty early with their proposals. They'll come up with a scope of work of is what would need to be done after acquisition in order to bring it up to code. Because essentially, in order to close, you're signing an attestation form saying you'll do this scope of work. And then there's some back and forth because there's cost to that as well. So there's back and forth based on the building about whether that's a good path for the client to take.
So if somebody's a newer multifamily investor, what sort of consultants should they be expecting versus if they're single family, they're used to a simple appraisal from the bank and they move? What happens in this situation?
Yeah. So, well, first, the appraisal, I'll touch on that since commercial appraisal is generally more expensive than a residential appraisal. It's also way more extensive. You're looking at a 50-page report versus 5. Energy consultant, if you're going the MLI Select route, will be a big one. In the situations which you don't really see in the space, if you're going the accessibility route, there's also accessibility consultants who can help be engaged in projects. And then outside of that, depending on the number of units, you might need a building condition assessment and you might need an environmental phase 1, which is different if you were just buying a smaller asset. If you're 5 or 6 units, you get away without some of that. But generally speaking, those are the players that you'd be engaging upfront during your due diligence phase.
I'll hand it back to Addy. Questions for Ribhu?
Well, lots of questions. So let me ask this. So with all of these programs, we're encouraging investors to juice up their returns, taking on more leverage. Is there a sweet spot? How do you make sure that your client is not overdoing it? Because we know that the number one reason why a lot of ventures fail, it's because they've taken on too much debt. They can't service the debt, or you have 50-year amortization and it's not paid off enough in 10 years and the value hasn't come, or the thesis hasn't translated into actual execution. How do you make sure that your investors don't get into trouble? And is there a sweet spot for that loan to value?
Yeah, for sure. So from a return standpoint, I guess I'll take a step back. So part of the initial analysis we do with a client is analyze their overall net worth and their portfolio. Because I think the risk where people actually run into with taking high leverage is if they can't really afford it. So just because they qualify for it doesn't necessarily mean they could afford it in some cases. And I think that's where the conversation changes a bit in terms of 95.5, that's probably too risky. So it's a good example we have because we have a mutual deal we're working on together where the client had excess capital and had the ability to potentially go 25% down plus, right? Ultimately ended up with 85.15. And it was a function of what is that capital? Does he have liquidity reserve if things go south? If worst case scenario, 5 years down the line, values haven't gone up, like, is he still in a good position? And after factoring in the principal pay down in the scenario we picked, after factoring in the liquidity he'll still have and the net worth he has across his portfolio, 85.15 made sense. So I guess that's a long way of saying, I don't know if there's a sweet spot that's a generic thing. I think it's more client focused and ensuring that client based on their net worth profile is, making the right decision to their profile. I think some of the risks that you might take might be different to the ones I would take.
There's actually funds out there that are taking some massive risks where they have their whole portfolio, and it's a hundreds of millions of dollar portfolio that is running using CMHC MLI program, and their portfolio loan to value is like 90% plus. So it's scary. So that's why it's also worrisome when you have tools like these available for the general public. And if the person that is helping you put this together is not cognizant of the fact that this could be a ticking time bomb for them, how do you make sure that somebody's not going to commit financial suicide with an investment?
Yeah, big time. So I like to think that's where I try to help people as an investor myself. I also say from my own investments, I'm probably more on the conservative side. So yeah, I think it's just that overall portfolio review. It's interesting because I heard the CMHC CEO calling people speak a few times, and they are nervous about it because on the residential side, there's three major insurers. There's Sagen, Canada Guarantee, and CMHC. But on the multifamily side, they're the only game in town. I remember we were at a private lenders conference a few months ago, and she said to the audience, she's like, anybody here wants to start an insurance company, please let me know. I will help you. So I think they understand that the risk is there. And I think that's why there's moving goalposts, it feels like every time with CMHC rule changes, seemingly every couple of months. It'll be interesting to see how things play out as people take more and more risk and then see how CMHC is going to respond to that.
Well, it looks like every year they make changes to the MLI program. I think this is year 3, and June is like the time clock stops, and then they make all of these changes. So can you just run us through some of the new changes that they have made? It was really, really good before, and now it's just becoming more and more difficult to qualify. So walk us through what people can expect.
Yeah, so I mean, it's like there's been a lot, but I think some of the key changes that have really affected people, at least within the last 12 months. First was, I guess a year ago, you could have funded side-by-side detached properties that were not on the same lot under one CMHC loan. We're seeing that especially a lot in Alberta. Then that rule completely changed. The properties need to be either on the same lot and conforming to zoning, which is the key part, conforming to zoning, like you mentioned earlier, and legal, or if they were on separate lots, they need to be attached, right? So that really affected a lot of people because a lot of the pre-construction selling that, now all of a sudden became ineligible for CMHC financing. That was a big one. Another big one was around rental achievement holdback. So we didn't really touch too much on CMHC construction, but you can get CMHC construction multifamily financing up to 95% loan to cost. And around the rental achievement holdback is essentially CMHC saying, we're going to hold back your last draw until you've leased up, essentially. It's still case by case, strong borrow. It's kind of a bit of a negotiation, but that also affected a lot of people, right? Because if you're expecting a certain capital outlay and now you're having your last draw held back, it really messes things up. So that was another big change. Another massive change back in as recent as July was the insurance premium changes on MLI Select. A big business case for doing MLI Select energy efficiency was even though you're spending money upfront to do the energy efficiency work, in addition to the DCR, et cetera, that we talked about, all those wins, there was also a significantly reduced premium for going the MLI Select route. But now all the baseline insurance premiums increase as of July, which makes the spread a little less attractive. But I think a general pattern, what we're seeing is when you see a lot of people flocking to certain things and seeing certain high risk behaviors, it looks like that's a good indicator of what CMHC is going to change next.
And I also find that CMHC is usually late to the party when it comes to their pricing. And what we end up finding is that the people that come later on into the game end up paying a brunt of the cost. And they're basically compensating all the people that were in early and compensating them for the work that they did. Run us through a client deal that, like, we have one deal that we're working on. We have the closing. Hopefully, it closes today. Run us through some insights that you guys are finding and some nuggets that you have uncovered while working with CMHC that our users or our listeners might find useful.
Yeah, sure. So we're in an interesting part of the market where there's a lot of motivated sellers. So seeing people close. Okay, so the base assumption on the examples I'm going to use is that a debt service is for CMHC. We're seeing people close one of two ways. Either the seller is open to longer closing, because CMHC does take some time to close, say 3 to 4 months. So even one of my own deals, personally, my 24 unit, we closed CMHC, we had a longer closing, and we closed on the acquisition with CMHC, right? In that scenario, you just need to be extremely polished. Broker or whoever you're working with needs to be on the ball with documents at due diligence phase to make sure you can execute in a compressed timeline. There's standard requirements. So anybody who's actively doing deals should have this checklist pretty down pat. What we're also seeing though is a lot of clients closing with cheaper bridge financing. The reason that they're doing that is because we are seeing sellers willing to provide big discounts off purchase price in exchange for a quicker close, 30-day close, for example. And a lot of bridge pricing is a function of prime rate, which has come down significantly in the last 12 months. There are a lot of bridge lenders too who offer very competitive terms, knowing that there's a CMHC exit will allow, like in our deal, VTVs in second position up to 85%. And we're talking banks, institutions who are being very flexible with a clean CMHC exit plan. In terms of nuggets, it's just being very polished and working with people who are doing this day in, day out. Because I think the biggest risk to a CMHC application is being messy and not having your package fine-tuned early on, risks identified early on, because that's really what could delay things. If you have your application to CMHC and it gets rejected, and now you need to get replaced back in queue, that could completely screw up the closing.
I think another point I'd like to say is be creative. If you have a solution that you think would work, make sure you raise that solution and bring it to somebody's attention. We had a problem where the city of Hamilton is not issuing any clearance certificates for zoning and legal units. And our deal would have stalled out had it not been for us going and saying, hey, let's reach out to the seller, ask them to provide us with documentation when they purchased the property, which was 10 years ago. Ask them to warrant it that it's going to be legal. If it's not legal, they would bear the cost of any inefficiency or deficiency that would come through. And we were able to move forward with the deal. So that's one example. And you touched on VTB. That was another item that we used where this buyer didn't want to put all of his cash into the deal. He wanted to buy it with 85% LTV. And we got the seller to put 10% of his own money into the deal so we could close early because we needed a lower LTV for the bridge. So seller was able to close the transaction earlier. The buyer was able to keep his money in his pocket, and the seller was able to put his money to use, and buyer was able to get into a CMHC mortgage as well. So don't be afraid of asking questions and being creative with your output that you're looking for.
100%.
Let's talk a little bit about the impact on cash flow and impact on your exit strategy. How does CMHC-insured debt affect investor cash flow monthly or on the back end? And how do you structure your exit when the debt is in play, especially when you have something, let's say, like affordability and efficiency if the work isn't completed yet?
Yeah, fair. So first, let's say from a cash flow impact. So, the downside of maxing out leverage is inherently you are going to reduce your cash flow. So, if you're looking at an apples to apples comparison, if you're switching one loan size to the other loan size, but with a stretched out amortization, you'll have see increased cash flow. But as a byproduct, if you max out 85/15 or 95/5, you're going to see less cash flow, obviously, than a 25% down product. That being said, the way I like to look at it is all percent return. So absolute cash flow number is probably going to be less, but your return, your dividend yield, or however you want to term it, will still be pretty on par with the Ontario market. From an exit standpoint, I guess, is your question more around we've acquired a CMHC, how do you exit down the line?
So if you have, let's say, affordability contract of 10 years, and you have a term of 10 years, can you exit beforehand? And if you have, let's say you're not even 2 years into it, you had some efficiency program that comes with it, is there a way of exiting before completing all that work?
Yeah, I got you. So I'll take a step back. So with CMHC mortgage, you either take a 5 or a 10-year term. Now, your affordability commitment is 10 years, regardless of the term you take. So even if you take a 5-year term, it's a 10-year mortgage commitment, or you haven't met your borrower covenants and you'd be in default of the loan. Just like with any loan, there's covenants that a borrower needs to meet, whether it be debt servicing, net worth components, and this just becomes one of the things that you need to continue to meet. Breaking a CMHC loan is extremely expensive. Essentially, what these lenders are doing is they're buying the CMB, the Canada Mortgage Bond, off the market and lending it to you for a spread. So they're also making a commitment. Right? They're buying this bond for 5 years. So it is very expensive to break a CMHC mortgage. It is interest to term. So whatever interest you owe for the rest of the term, that is your mortgage penalty. However, what you see most people doing if they were exiting CMHC mortgage or a building with a CMHC mortgage on it, CMHC mortgages are assumable. So that if you were to sell a property, the buyer likes the terms, they can assume the mortgage that is currently on the property. You can also increase the loan, assuming can debt service a higher loan at the time of exiting. The new borrower can, which is an alternate way to kind of work that out. But yeah, generally speaking, if people are exiting, it would be some sort of assumption to a new buyer. I have not seen anybody try to exit within that term because they haven't met the covenants, because it is extremely expensive to do so.
I have a deal for you. We're going to be talking about this afterwards.
Okay.
Because we're looking at a deal right now in Waterloo. It's a 14-unit building, and the agents, it's not our listing, it's another agent's listing, and we had an offer on it, and the seller just found out that he's got to pay $190,000 worth of fees because he's got 5 years left on it. And the conversation we're having with the agent right now is saying, hey, we can assume the mortgage if the seller is willing to put a little bit of VTB with it, because it's a $1.2 million equity check that we have to write for this 14, 15-unit building, that the buyer is not willing to do so. Your client gets to save $200,000, and my client gets to have a property that has a really, really good rate on it. It's 2.55%.
Yeah.
It's worth saving. Let me ask a question. Principal pay downs. A lot of times with mortgages, you have the option of paying down your principal. Is there such a mechanism available with CMHC mortgages?
Yeah. So the only principal pay down would be what's coming out of your regular mortgage. But usually there's no prepayment option. So again, it's the lenders has taken the money out of the bond market. They can, on the flip side, pay it down. It's different. So usually on a conventional mortgage, the bank's lending with their own funds. It's a bit of a different mechanism where they can lend that money back out. But in terms of the CMB, once that's bought, that's locked into your mortgage. So you usually see the principal pay down from your regular mortgage payment every month. That's about it.
So is there a scenario where you wouldn't recommend somebody going to a CMHC route? I know we've been talking a lot about MLI. So I want to break this into 3 buckets. So you have conventional, then you have CMHC conventional, and then you have CMHC MLI. Is there a reason you wouldn't recommend somebody going to MLI or CMHC conventional and go to like a conventional mortgage?
Yeah, for sure. So I can use a real example for a deal in Cambridge that gotten a letter LOI issued on. The client already owned the property. It was a refinance. The asset's not that great. It's old. So the value is probably not the max that another asset of the same NOI would be, just because of the data. Ultimately, the loan on the CMHC at 85% loan to value is only going to be about 1.2 million. Versus we could have gotten him a conventional loan of about just over $1 million. He had very limited debt on the property. I think it was like 200K or something. Knowing this client's financial profile, knowing he has other assets, knowing he has other stuff. In that case, I didn't think, and I guess he agreed with me because we didn't move, so we ended up moving forward with conventional. That it didn't make sense for him to pay the insurance premium, pay the fees associated with it, in order to take out an extra 150K. Now, for some people, that 150K is worth it, and they can stretch that a lot further. In this guy's case, he is a bit older in his investing career. He has a net worth, and there was no extra incentive for him to take that 100. So in a situation like that, if your overall portfolio, if you don't need the extra leverage, there is cost to taking this, right? That insurance premium is added onto principal and is there forever. If you don't need the extra leverage and you're okay with a little bit lower rate of return, then yeah, CMHC is just a tool, like I said, at the end of the day. Now, where I like to use it is somebody who is aggressively scaling or aggressively trying to grow their portfolio or trying to get into a property for a long term, then it makes more sense. But if you're later on and you're looking to just hold any property debt services anyway, yeah, it's probably not with the insurance premium.
That's very, very valuable point. Where do you see the CMHC insured mortgage landscape heading in the next 5 years?
Yeah, so that's an interesting question. I think that's anybody's best guess. I see them continuing to change rules. I see them continuing to tighten up based on trying to risk across their portfolio. That being said, I don't see it going anywhere anytime soon. I think it's been a major catalyst for what we're seeing in the boom of multifamily construction in a much needed time, where there's a massive housing crisis going on. There's a lot of small mid-scale development that's popping up all over Toronto, the missing middle stuff, as they like to call it. And personally, I don't see the program going away anytime soon, but I do see them tightening up. I think fundamentally, though, if people are buying good quality, real multifamily assets and good locations and good fundamentals, you'll be good. I think it's just people who are trying to hack the system who might get upset to bit of hard times. But yeah, I think the program's going to be around for a long time. Can't see them taking it, but yeah, just tightening up a bit.
Now, if I recall correctly, I think start of this year or end of last year, I know the lenders were really, really tough on 5-year mortgages. They didn't want to give anybody any commitments for 5-year loans, especially if they were under 1.2 or $1.5 million. Has that changed now? What are we seeing in the marketplace? Because they were at one point, liquidity was really, really tight for CMHC. Has that improved any? Have you seen any changes there?
Not really any changes. So how it works, as you would know, but Sheffield, is there is an allocation. So every lender has certain allocation of CMB through which it can lend. 5-year debt is definitely in high demand, and allocation is hard to come by. I'll say as an individual borrower going to a lender, it's a tough sell on the smaller loans because they're trying to allocate this to rope in clients, generally speaking. There are lenders who are issuing 5-year terms still, 5-year pricing, but it is very lender specific and deal specific on whether they're willing to offer that or not. Overall, though, allocation continues to be tight. And depending on the time of year you go in, it can be tighter and pricing would adjust accordingly. But I think it depends on the lender and the time of year and deal by deal. That's all. It's tough. It continues to be tough.
Any innovations or shifts that investors should be aware of?
In general, in the CMHC markets,
General market, CMHC, definitely. Anything in the
yeah.
mortgage world, anything that we should be aware of that you think is coming down the pipe that we should be paying attention to?
Yeah, so I think it is a great time for, we're talking about a lot of smaller investors scaling up into multifamily. I think it's going to be extra important for people to understand how to do that. There's been a lot of chatter around OSFI rules around qualifying for residential rental property, and they're going to treat income for subsequent properties. So if you use income to qualify for one, you may not be able to use it to qualify for another property. And I think a lot of small to mid-sized investors who have adopted the smaller 1 to 4 unit strategy in the past are going to get capped a lot sooner than they would like. I think it's important for people to be aware of that and start taking advantage of these opportunities you're talking about in the multifamily space, where there is deals and there is negotiations to be had before a lot of that comes into play, which will then shift the entire market into that $1 to $3 million multifamily CMHC space. I think that's a big one for people to keep an eye on, especially if they're looking to grow their portfolio, because it's going to continue to get harder to qualify for residential mortgages.
It's interesting that you say that because we're already seeing anytime a property that is priced well that enters the market, it gets multiple offers. Out of the last 10 offers that we have done, I believe 8 were in multiple offers. We have 2 offers out right now, and both are in multiple offers. So it's
Wow.
very, very competitive right now in the multifamily space, especially under 5 million. If you have properties in that space, if the property is priced well, it shows well, and you have marketed it halfway decently, you will have a bunch of buyers that are interested in it. A couple of last questions. If you could give the listeners a quick yes no checklist, 5 things to check before committing to CMHC mortgage, and what would those be?
Yeah, so I think first one would be understanding your max rates. We didn't really touch on that, but simply it's the maximum rate at which your deal is going to qualify. We're seeing a lot of volatility in the bond market in the current political environment. Just ensuring that you have wiggle room in your qualification is going to be key, so you don't have an expensive buy down on closing.
So this
Uh,
is the interest rate we're talking about.
correct. Correct. Max rate at which you qualify. So, yes. So that would be that. Second one is how badly do you need the leverage? Like, I guess if it's yes or no, do I need this leverage that badly? In the case of the refinance versus conventional and paying the insurance premium. 3, does this deal pencil out if CMHC went away tomorrow? Yes, no. 4th one is a good one to make me think. So let's say number 4 would be, do I believe the asset is worth what they say it's worth, even if CMHC financing wasn't around? The last one is, am I aligned with sticking in a long-term investment, knowing that CMHC is a 5 to 10-year term?
That's interesting. Those are very, very solid points. It's a great way to build your thesis. Kaz, you're the guy who has a lot of questions about thesis and about the numbers. What are your thoughts on that?
I think the 5 and 10 year thing is really interesting, right? Like people are evaluating that. Because when you think about the amortization, they talk about 50-year M's. So people, as you said, cab drivers and people on the street think that's the interest rate for 50 years, but it's not. Like it's 5 years, then it comes up again for that. So you're seeing more people, I guess, commit to 5 years versus 10. Any particular reason why you're seeing people doing the 5s versus the 10s?
Yeah, so I think that there's 2 groups of people. I'd say one group wants a 5 because they want flexibility. And generally speaking, the 5-year pricing tends to be cheaper. On the flip side, I'm seeing a lot of people who are a little bit more bearish on the long term, who are locking into 10s. Because even though as of today, the 10-year pricing is higher than the 5, effectively, they would rather that long-term stability, especially because they're taking higher leverage at a longer amortization. So in 10 years to go, I'd say a lot of people seem to want that first bucket of short-term flexibility, which is why 5 seems to be in higher demand. But there is a mix.
One of the myths that we hear out there, and curious if you can dispel it or prove it's true or not. It's advertised as 95%, up to 95%, either loan to value or loan to cost. But sometimes we hear people are like, well, nobody gets 95. When I've never seen 95. I've had people say that. In your experience, do you see the 95? Is that a real number? When people are out there thinking about stuff, if 95 is not in reach, it's good for them to know ahead of time when they're trying to evaluate opportunities, right? So what are your thoughts on that?
Yeah, fair. So I'd say 95.5 from a loan to value standpoint seems to be very common right now in Alberta. So I'd say a lot of Alberta deals pencil out. So Calgary, Edmonton, a lot of them qualify for 95.5. And just as a byproduct of their median renter income being so high in Calgary and Edmonton, affordable rents actually, that's defined as a higher number than Toronto. So I'm seeing a lot of that there. Southern Ontario, personally, I haven't seen anything really qualify for 95.5. Some people on my team, like they've done some in like Northern Ontario tertiary markets type thing, but Southern Ontario along the 401 corridor, I haven't seen anything that either qualifies for 95.5 or people want to commit to affordability in order to get 95.5. Because then you're just compressing your asset growth, like then. There's a lot of risk in the Ontario market. One of the benefits is prices are higher. So capping your biggest benefit of being in Ontario, it's a little tough.
That makes sense. And then going back to what you were saying earlier, a little bit about the bridge financing. So sometimes people want to build, they may not be able to get their CMHC on close. So what kinds of bridge financing are you seeing? What kind of rates, term, that kind of thing, so that people can buy the time, literally buy the time to be able to then get some CMHC?
Yeah, so generally speaking, there's 2 classes of bridge financing, like 2 big buckets. One with banks can get B lender type bridge financing for prime plus 1 to prime plus 2, which is depending on the loan size, which is pretty competitive. It is interest only and fully open. It's meant to be a short-term fix. It's not meant to stay in the deal for a long. For whatever reason, you need an extremely quick close or borrower covenants, or probably the property is entirely vacant, rough shape type thing. Then you start to get into private capital firm bridge financing. But I'd say 95% of clients end up with some sort of bank bridge, like the prime plus 2%, right?
Go
So you're
ahead.
looking at like something like 6%, am I right?
6.7 only. So
That's
it usually
cheap.
makes sense because so that's where the banks are at right now. The only time we end up going with the private capital firms we see is like, let's say it's a big value project, so meaning renovation that needed and all these things. Then we potentially need to get higher, but yeah, prime plus 2 is what we're seeing on bridge right now.
So as far as for the properties that somebody might pick up where there's renovations or value add required, would they build that into their CMHC thesis? Would they bring that part as part of the bridge financing? Like, how do you help them navigate? Let's say they need an extra 100, 200 grand
Sure.
for renos.
Sure, yeah. So in a situation like that where the renovation path is clear, we would do the bridge financing with the intent to get everything done before exiting into CMHC. So that scenario would be leveraging the higher valuation post renovation to exit into CMHC versus the purchase price. In some cases, people are just doing the bridge to buy the extra 2 months so they could get a discount on the price. In that case, it's a linear 1-to-1 purchase price. We're not rolling anything extra in. What's interesting too is on some of the larger renovation projects, so say a couple $100K type thing, you can fund a percentage of the construction as well. We work with bridge lenders who will fund 75% of purchase plus construction. These are usually for people who are doing massive renovations, adding units, that type of thing. And then, yeah, we'll roll everything into CMHC loan once that's done at the high valuation.
We've talked a lot about the positive things. I'm going to throw a tough one at you, so be ready for this one. Walk us through, again, protect the innocent, don't give us names, but a bit of a horror story, right? Somebody was looking to get financing with you and it just, unfortunately, the deal fell apart. What were some of the challenges and maybe what did you learn from that experience?
Sure. So one of the ones I learned early on was the whole legal non-conforming piece, like Addy mentioned.
Okay.
That one's that a lot of people don't think. Because if you just go to a conventional lender for 75-25 regular financing, a lot of them will consider a legal non-conforming once it's legal. You can get credit union, etc. CMHC will not. They don't like that. So that was one thing done that was important, especially in the smaller unit space. You see a lot of examples where they may not be conforming or not fully legal. And Geo Warehouse is not. People use Geo Warehouse as a rationale. No, please get zoning certificate or zoning compliance from the city, not Geo Warehouse.
You can't rely on MPAC
No.
either. So it has to be from the city and it has to be on their letterhead confirming the number of legal units that they have. It's very, very important.
So for our listeners out there,
Yes.
that's the process, Addy, is what people should be doing.
Yeah, they should be calling us. We will help you buy and we'll make sure that it's a legal property.
Yes.
Okay.
And we can help you with the CMHC, MLI, and conventional mortgages
Yes.
as well.
Yes,
So
thank you.
actually, that's a really good segue. So for investors that haven't used CMHC before, what's your advice for them as their first step?
Yeah, so a bit of a self plug. Work with a broker who's done a lot of these deals, who can explain the process in a thorough manner. Right, it is a very document heavy process. It's a bit cumbersome, right? There is a lot of deep dive into your personal net worth and all of these things, and a lot of people who get involved with it, their experience is residential mortgages. It's a very different process. We're not asking for pay stubs, but there is more into your personal net worth and things like that. So I think just taking your time at the start, understand what that process is going to look like, understanding all the fees, understanding what the CMHC insurance premium are, understanding that appraisals, everything costs multiple times more than a residential deal. Just knowing that upfront will be spending the time to learn that upfront is key, because the numbers still make sense. That's why everybody scales up this way. But if you don't know it going into a deal, it could get pretty intimidating for sure. My first deal, I remember being alarmed by that. It was a big reason I ended up going into brokering, because my first larger deal, I mean, it wasn't that big at the time. 1.1 million transaction size was massive to me. And a lot of these fees, it completely took me off guard. And yeah, I didn't want that to happen to anybody else.
Yeah, no, it's important for everybody to understand, like your appraisals are not $500 like they are in residential. They're probably 4, 5, 6 times what you would pay for a residential. If you have to do environmental, that's $3,000 to $5,000. You have to do a BCA, $3,000 to $5,000. Your standard due diligence on a building that you're looking to buy we budget anywhere between $15,000 to $25,000 per acquisition or per transaction that you're doing. And that does not even include if you have to step into like a phase 2 or phase 2 environmental. You step into a phase 2 alone is $20,000. So there's some massive costs that are associated with it. So it's good to have, it's good to work, it's good to introduce somebody who's experienced early on in your transaction. For example, if you're negotiating a transaction right now, reach out to somebody like Ribhu and say, hey, Ribhu, here's the property, here's the rental, here are the expenses, get me my different scenarios. That's how we decided when we were initially on the deal that we're working on. That's how the conversation started. We sent him an email saying, hey, Ribhu, this is the property we have. Here's the rental. Here are the expenses. Give us a couple of options on what we can do as a conventional, CMHC conventional or an MLI. And then based on that, we were able to fine tune our underwriting and go back and negotiate much harder with the seller, telling them that their expectations are not matching what the industry or the market expectation is. And this is where the price needs to be. And we were able to get thousands of dollars off on the asking price.
Yeah, that was a good deal, Addy. Good job.
Anything else that we should know about Ribhu?
No, I think we hit all the key points. I think that obviously there's a lot more nuance involved with a CMHC application and multi-financing once you start to get into bigger and bigger loan sizes. But I think we hit all the key points. And then from there, I think you learn as you go.
No, that's great. For anybody that wants to get in touch with you, what's the best way for them to reach out to you?
Yeah, so I'm pretty active now on LinkedIn. So Ribhu Rampersad is my name there. Email as well, ribhu@ribhurampersad.ca. Also pretty active on Instagram. So if you just search my name, there's multiple channels. I'm pretty active on all of them.
And we'll make sure that his contact information is included in the show notes. For anybody else that wants to connect and want to have a conversation, book a call with us, calcal.westcliffam.com. You can listen to this podcast and past episodes at westcliffam.com/listen. You can join our online community, win.westcliffam.com. You can find us on social media or wherever your podcasts are sold. If you're looking to connect with us directly, you can reach out to us by calling 647-799-2264. You can text that number as well. info@westcliffam.com, westcliffam.com. Thank you very much for everybody for joining today. Please note that this information is for informational entertainment purposes and not investment advice. Please reach out to a professional investment or accountant for any investment related advice.